Okay, good morning, everyone. We are just going to start. As we're getting to the end of the year, we are entering the holiday season. I'm going to give you a bit of an overview of the structured products market of 2023. We'll do a bit of an overview, as well give a bit of an estimate of what we think is going to happen next year. Now, we have a full agenda. We will open for Q&A at the end, but the system will allow you to the Q&A to any questions that you want. So, feel free to add the questions as we go. So let's start with a couple of economic and regulatory landscape review. Okay, so first, let's talk about the equity markets. I mean, it's quite clear that, technology has been the one who has been having an amazing impact, especially the top 7 tech stocks, Nvidia, Apple, and so many others. And you can see that small cap still positive, but underperforming the S&P 500. The other thing which I want to highlight is the VIX. VIX started at, it's been slowly going down, especially in the last 2 months. And it's now at 15% levels. So it's basically half of what it was at the beginning of the year. I think that's quite relevant as we will discuss about also interest rates. Now, also a bit of a highlight, and I think we spoke about this whenever we came to our US conference in Nashville, was the prop index business, who has been underperforming quite extensively. And here what we put is the table of all the prop indices, or the most popular top indices in structured products and annuities in the US. What you see is that performance year to date is mostly negative. And if you look at the last 1 year and 3 years, it's still very negative. Of course, this has to do a lot with the risk control, the lower volatility, the 5% risk control indices underperforming. The one which we highlighted last week, performance was amazingly well, and not surprising, was the Mercube US Tech Plus Vol Advantage Index, which is up 52% year to date. Of course, he has a target volatility of 35%, all technology, and this has been the index that has been, has the best performance year to date. And we'll talk about it, what we think it's going to we're going to predict for next year for risk control. But we saw that these negative impacts also impacted sales of the market-linked CDs, and even some of the structured notes linked to these indices. Their sales went down quite extensively, even though interest rates are much higher. And then, of course, you have on the right the yield curve. So we kind of have a inverted yield curve, slowly going down. And the estimation is that the Fed might lower interest rates next year. And I think this negative yield curve, the lower volatility, it has an impact, especially on the structured products that have been selling. I mean, year to date, capital protected products had the biggest growth, which we'll show later. But income, especially short term, have been very, very good products. Especially has short term volatility is usually higher, and you could see that the main indices, the S&P 500 single index linked structured notes, have been the most popular. So let's go through a few trends, and later on we'll show you the league tables and some of the interesting trends. Now, we talked about it during the last months, but we're going to highlight a couple of interesting ideas. Correlated worst of baskets, innovation that Bank of America did. What I found very, very interesting, is that you see there on the text on the right bottom is the average annual yield offered by Bank of America these products with one single, two underlyings, or worst off of three. And what we saw is that there was a slightly better improvement on the S&P, and S&P 500 equal weight worst off. So they were offering a couple of them with almost 10% analyzed coupon. Of course, you're betting here on tech not to fall, but we found it was quite interesting when compared with free underlyings, especially as it's not been very popular in the US, but the worst off between big, large cap around the world, S&P, the Euro Stoxx 50, some of the Hang Seng or Chinese or Japanese large cap indices perform extremely, extremely bad this year, especially because China performance has been awful, and the Hang Seng has been down for the last 2.5 years. And that has made those products having their capital at risk. So, looking at two single index, just two underlyings, it seemed to us quite interesting. Then I think it's a capital protected autocallables. I mean, this is something that we couldn't see, that it didn't exist in the last 5-6 years. They're now back, and they've been very popular. You can see there 3 different issuers: JP Morgan, Morgan Stanley, and Goldman Sachs. And what you see there is 4 or 5 years market-linked CDs, worst off between 3 large cap indices, right? But you have 100% capital protected, quite interesting yields, 6% analyzed yield, quarterly autocall barriers, some of them even at 90%. So quite defensive products offering income, and I think that's interesting to see. Market-linked CDs using autocallables, income autocallables as a way to attract clients. Especially on the more conservative clients. And then callable yields providing steady income. So what you see is that, last year there was a lot of on growth as the markets were rallying. What we saw this year is a big increase on income. Okay, so you can see here that even year to date, remember, we don't have the December numbers. We'll show you the November numbers, but you can see here it's till December. It's up already compared with how much was sold last year. Remember, last year was a record year. And if you add there the callable, the fixed income products, right, the callable notes, the floaters, it's really going up. And on the right, what you'll see is the average coupon barrier and the average coupon rate. And what you see that, in these equity income products are offering annual income this year almost of 12% per annum, and a coupon barrier of 67, 68%. So quite interesting, quite conservative, especially due to the high interest rates environment. Using autocallables, not less growth autocallables and more income. Phoenix, Phoenix, and so on. Now we're going to give you a bit of a view of the year, and then we're going to talk about 2024. But here, what we're going to do is just give you a bit of an idea of the investor perspective and sentiment, and why do you think the market is where it is, and what do you think 2024 is going to happen in 2024. So slightly positive sentiment. You can see there an interesting graph from Yardeni Research on the ratio between bull, bear, and ratio. Most people talk about how the market is quite high, but when you look to the sentiment, especially the P ratios, so the price earning ratios, you can see there on the right, they're actually not that high compared with previous years. I mean, you can see again before the tech burst, we would have P's of 100. It went down. It went up from 2010 to 2020. Big increase in 2021. and it came down and now it's slightly up, but still slightly below the average since 2000. So quite interesting to see that actually, maybe the market is not as high as we expect. And this is what we'll also put on our ideas for next year. And there you go, some US structured products. I mean, so you can see last year as well was 23 year to date. Just a small reminder, we don't have December numbers here. And you can see JP Morgan is the one who is growing the most. Okay, they've been very strong, quoting in almost everything. What we saw in terms of the downside is a decrease of the Citigroup. I mean, the last 2 years they were very, very aggressive. I mean, November was just awful. I mean, Citigroup just issued 80% less in November. Just above 200 products. Just less than $300 million. It was quite bad for Citigroup. Again, you can see Goldman. Last year they were leading. This year, they especially at the beginning of the year, they were not issuing as much due to their funding and treasury. But what I can see is that the last few months they've been recovering. Barclays, of course, is going up now on top 4 after what happened last year. And Morgan Stanley also losing some steam. I would highlight, especially with November, it's the Canadian banks, UBS. UBS came quite strong in November, and you'll see the numbers from our market review, which we'll release next week. And of course, Canadian banks. On the distribution side, and again, we mixed here a bit of distributors and wholesalers. But what you see is massive competition between UBS and Morgan Stanley Wealth. I mean, almost every week they change swap between the first and second. Now, Goldman Sachs also getting strong, especially on the IFA market, on the RIA market. Merrill Lynch, which is slightly below last year. Inspirex, which we've been having a very strong year, especially on the fixed income side. And of course, you have LPL, First Trust also having very, very good, very good increases in numbers compared with last year. Then in product types, you can see, capital protected products, considerable growth. Q2 was, slight decrease. But Q3 also you saw another pickup, and I think Q4 you also see that number stabilizing around 8, just below between 8 to 9 billion, probably more to the 8 billion. And what you see is income. The income products, especially on Q3 and Q4, are the ones who are selling the most, and they're back. Again. Year to date, you'll see that auto-callables are down 14% versus non-auto-callables, especially due to the fixed income rates. But you can see there, especially the Phoenix product subtypes, which provides regular coupons versus their auto-call barrier, growing 200%. But also you can see cap protected participation going 300%. So capital protected products with participation rates. Again, you can see, so interest rates represent almost 20% of total volume sold as of today, 57% to equity indices, 40% equity shares, 6% multi-asset indices, especially the prop indices, but also other ones, and then you have remaining the other asset classes. Again, slow decrease on the single S&P 500 index. So now represents 24%, with 9% with the worst off between the large caps of the Nasdaq, Russell, S&P. But remember, a couple of years ago, that was like almost 40% of the market. It's now only 9%. So you can see a lot of single index linked products. And you have the sector ones, again, large cap, interest rates, and then of course technology. with 5% of total sales, which is very, very significant. Wait a second. I think some people complain about the size. Let me just... Perfect. I think you now will be able to see a big size. Okay, let's go to the next graph and let's talk about 2024. Now, a month ago, we estimated and we gave that numbers that we thought that the total volume sales would slightly go down 1%, but that was when the S&P 500 was at 4,300. Now, during the last month, it rallied almost 300 points, and that means that the number of photo calls expiring that are now in the money is much, much higher. So now we believe that there are more tailwinds for structured product sales for next year. So it increases our estimate, and we now believe that next year it will go up 4.3%. to $127 billion. So another record. And again, you can see there, again, we'll send the slides to everyone, but you can see there that projected sales between 120 to 135 billion, depending how the underlyings perform. You can see there a lot of early redemptions, especially if S&P rallies even further above the 4,600, a lot of coupons, and I think these coupons are almost a lot of them are almost guaranteed because of the very Phoenix. So my advice to everyone is looking at the coupons that these are going to be paid, right? Because the investors will look at how to reinvest these cash flows. Okay, and of course early redemptions as the second one. Maturities, also big number, almost $80 billion of maturities coming back to the market. So a lot of market CDs, more growth products that are coming to their maturity. Before I go to Q&A, which again I'll ask you to start sending questions. We wanted to be a bit more enthusiastic and try to give you some predictions for next year, besides the total sales. So we came up with top five predictions for next year. Okay, and I think the first one is interest rates product sales to plunge. I think with the Fed and with the market believing that interest rates are going down, I think we'll believe that interest rate products might halve during 2024. Also, a lot of the auto-callable fixed income products, a lot of the issuers might call them, right? Especially if the equity markets perform well and the interest rates are lower, so that they can get the better funding in 2024. So I think these products sales might plunge. Then the other thing is upward trend in risk control indices. With inverted yield curve, lower volatility, I think this will help risk control indices. We've seen more coming back in the market. I think this slightly changed the market dynamics, especially as risk control indices perform bad when the markets are recovering, when there is a big crash and the markets recover again, as to maintain volatility at low levels, 5%, you're disinvested. And I think if you think interest rates are going down, equity markets perform, volatility is now low. I think we'll see this index, especially the risk control, performing better and increasing more in terms of sales. The other one, I think it's a prediction, but it has to do with the numbers we have. I think auto calls will surge, especially on Q1. A lot of early expiry is expected. Okay, especially on Q1, a lot of auto calls. Q1 this year was very, very good. So I think a lot of these income products will expire early. And I think we will see more competition, even more competition between the giants, especially as Credit Suisse and the UBS merger is now finalized. I think we'll see them coming back to the market. I think because of funding levels, I think Goldman Sachs this year was a bit out of the market, and I think we'll see more competition from them. So I think we'll see, JP Morgan's been the leader in terms of issuers, but I think we can see much more competition next year. Okay, so I'll give a few more minutes. Let me go through Q&A if there are any questions. Yes. Of course, we'll share the presentation who joins, and of course with the SPI subscribers. But yeah, we'll definitely share the presentation. I'll give it more time. Okay, so I don't think we have any questions. So look, thank you for attending. We'll send the slides to everyone who joined us. Okay, and if you have any questions, please feel free to contact us.